Conn from Community Access Lending here. He's going to update us on what's happening in the lending world. Rates are rising just a little bit here, and some realtors and borrowers are getting a little concerned that maybe it may get out of hand here. But Mark's going to clarify all that for us today. And Ruth's trying to bring up some stats. Mark, you're in Las Vegas right now, correct?
I am in Vegas.
I actually saw the Panamera Towers behind you, so you must live in one of the towers.
I'm in the Martin.
Okay, fantastic. So obviously the baseball world, or not World Series quite yet, but the playoffs are going on right now, and you're in town an extra longer. Did you put any bets in any of the playoff games?
I am a huge Giants fan, so
I'm sorry to hear that.
With my heart. Yeah. So it was looking good, and then it was looking not good. So.
It was looking real good.
You play today, we don't.
Yeah, right. I was watching the seventh inning actually when your pitcher closed out the seventh inning. It was tied 1-1, and then I had to go put the kids to bed, but came back and saw the scores.
I was really hoping that we won because when I'm in New Orleans, to go to Atlanta is so easy. So we were talking about doing a little road trip, which I've never been to that stadium. So the Dodgers screwed it all up.
Giants, surprisingly, for a pretty small market team, considering or against the rest of the league, has done fairly well over the last 2 decades. They'll either go bust in a season or they'll take it all the way to the World Series. So kind of crazy out. I'm from the Bay Area too, and I remember the Bay Area World Series, when the earthquake happened in 1989, right?
Wow.
88, 89. San Francisco Giants against Oakland A's. And unfortunately for the Giants back then, too, the Oakland A's swept them. So,
yeah. That was 2 incredible teams also. I remember really well. But A's had the pitching that we couldn't.
Dave Stewart, Bob Welch back in the day. I don't remember any of the
Eckersley, I believe, too.
The closer, right? So, but anyways, Ruth, before we get back to Mark in the lending world here, what's going on in real estate?
I am going to put you all in the lobby so I can show everybody the stats, and then I'll bring you back up and we'll talk a little bit about what's going on in Las Vegas. Hide ya. Show the stats, everybody. And here I'll go down here. So it is 28 days of inventory today. That's a great stat. We have about a month of inventory. We listed 184 homes yesterday, which is awesome. 148 of those homes were single family homes. 64 of those were 400 or under, which is super. We now have 833 active homes at 400 or under, which is fantastic. And again, it's churning. I keep saying the same thing because we put 87 under contract. We closed 150. And our average sales for October midline is 122 sales a day. So that is a terrific number. We've closed 1,827 homes, condos, townhomes this month so far. And just for edification, this is not new homes. This is resales. I had somebody reach out to me on YouTube and say, I don't believe there's only 28 days of inventory in Las Vegas. And actually there is. But if you go on realtor.com or some of these other sites, you'll see maybe 3,000 or 4,000 some days. But I don't know if they're including rentals. They're including all of Clark County, which I don't. I only include the greater Las Vegas area. And I actually put the zip codes in the response to this gentleman who was questioning the days of inventory. So we only do the zip codes that encompass Las Vegas and Henderson. We don't do Boulder City. We don't do Pahrump. We don't do Jean. We don't do Mesquite. So just to clarify that for everybody, when you go on these other sites and you see more than 3,925, that's why, because you always need to know where your statistics are coming from. So the non-owner occupied homes, which are bought by investors, we're selling about 45 of those a day of the 122. So they're more than 25% of our market. The $1 million homes are still going off the shelf, about 4 to 4.5 a day, beating last year, which was 1.5 a day. So those people are bringing money here. 130 people move here every month. And it's because it's such a great place to live. No taxes like you have in other places. We do have some taxes, but we're the lowest property tax state. No inheritance tax, no state income tax. So all of those things play into why people move into Vegas. So let's get our, whoops, I hear some reverberation there, fellas. Let's see, here comes Max. Max, I want to go over a little bit what's going on in Vegas for the folks. Some workers at the casinos are facing their vaccination deadline yesterday. And I don't know if everybody knows it, but a lot of the casinos are requiring, their workers to have the vaccination. And MGM and Westgate implemented this new policy, recently. So their deadline was yesterday, and I will see what the results of that was coming soon, I'm sure. Yeah. So let me hide that for a second. And what is going on? Well, Halloween is in Vegas, right? And if you go into the neighborhoods, you're already going to see lots of decorations. And there's the RJ, the Review Journal, ran a great article today on 31 simple and cheap Halloween decorations. And I'm going to put that in the comment section. So if anybody wants to click on it and go to that RJ page online, it's really cool. They've come up with some really good things to do. Oops, went the wrong way. Hold, please. Let's see. This is the one I wanted to show. Number 18 of the 31. So you take your old wine glasses that you're not using anymore, and you turn them upside down, and you take a little bit of hemp rope, and you make this festive-looking
it sounds like candle holders. It looks like candle holders, like pumpkin candle holders.
Well, and then you can put a bloody candle on top if you want to, and they tell you how to do that too. And then you can buy this at the dollar store. So anyway, these are 31 inexpensive ways to celebrate Halloween.
Right. And if you're a planner, wait till November 1st, and you can get a whole bunch of Halloween stuff for super discounted prices.
Well, the funny thing is, a lot of these stores sell out, so you don't see. Yeah. Next Saturday, there's the historic Fifth Street Book Festival, and I just want to bring that to everybody's attention. It's drawing some major authors to come and share their wares at the book festival. So that's something really cool. And then we have Lady Gaga and Stefani returning to the Strip. So Vegas is rocking. It just is. I love this place. Yeah. It's just so cool. So I just wanted to bring a few little of those tips. I didn't do any sports things like with the Knights and the Raiders, and then I thought I'd leave that to the fellas today. So right. Let's get Mark back up here. Let me find him. Where'd he go? I lost him. Oh, there he is. Hey, I see you. I found you. Okay. Right. Well, welcome, Mark.
Yeah. Welcome back, Mark. Welcome back to the show. I mean, rates are moving up. So again, Mark, for anyone that's just tuning in right now during this section of the show, we have Marc Conn on the line. He's a mortgage lender with Community Access Lending here, and he's been on the show a couple of times. He's really knowledgeable about what's the whole process of the lending process and all the programs, which has always gotten me thinking. Actually, once Mark has got on the show, I've started thinking about some strategies and possible strategies with my investment property too, as well. So, Mark, welcome back.
Thank you.
Yeah. So let's talk about, it looks like rates are rising a little bit, right?
Yeah. As soon as they start mentioning that word taper, the bond skyrockets. The bond right now is pretty much where it was as the pandemic started, which was the last worrisome time in my memory of when rates were going up and not going down. Like we're having 3-4 worsenings versus any improvements.
So Mark, I can interrupt you. A lot of people don't know why the bonds affect the interest rates. Can you kind of just give a short explanation for us?
I mean, it's pretty much how the hedges are taking place, and it's the forward money. So if we have to offer a higher yield for investment in our treasuries, it's going to affect everything. The Fed fund rate still is unchanged. As soon as that starts going up, it's worrisome time. But that's how the banks borrow behind the scenes, and they have to kind of hedge themselves with what's going to be going on 5 years. There's, a big 2-year auction. There's a big 10-year auction. The 10 years is what really affects us kind of, day by day. It used to be the stock market was red. We'd have a good rate day. Stock market's green, bad rate day. Now it's a little irrespective of that, because you could have a horrible bond day while the market's going up, and then all of a sudden we're benefiting from it. But it is important that you watch the market and just don't let stuff float now, because it could be catastrophic. We lost, I would say, the week prior over 100 bips in pricing. So that's not like a 3% rate goes to a 4%. But if you were buying let's say if you had a $500,000 loan, it's going to cost you $5,000 more after last week. So that's I don't like that. I'd rather have it go up a little slower and go down a little slower as well. But it's been jumping around this past week. But we've had some good news too. The conforming loan limit got raised. So they're anticipating that for 2022, and they added out here 52, 25, about $77,000. So it's at $625K now, and it could go higher. They haven't touched the VA or FHA. That's really going to help Vegas if the FHA can go up. 400K. When I first started doing loans, it was definitely, I want to say, low to mid 400K was the FHA limit, and our values are kind of right there again. So it's supposed to go on median income and all that too. If they don't want to raise the FHA, but all the prices are going up, it's going to make them very uncompetitive out here. But we need that product in Vegas.
So go over that with us again. What was the old conforming loan limit?
548, 200.
Wow, 548. So now it's 620.
625.
625. Wow,
yep.
That's a big jump.
And most lenders are recognizing it. It hasn't been announced yet, but that was one of the big things about, I don't know, a week and a half ago. A couple guys started going first, but that's, it's awesome to bring somebody from jumbo world back into conforming world. Number one, you can go 5% down all day long. Where jumbo, it's really tough to do a 5% down program. 10% minimum, then you're paying for the no PMI. And so I like it out here. It's definitely reflective of the market, because you see, I see stuff that gets put on, bought in the beginning, end of spring, beginning of summer, and they slap 100, 150K on it and put it right back on MLS now. So a lot of the houses that were affordable are they still affordable? Yes, if you're in a conforming loan. Maybe not if you're in a jumbo, because the difference, if someone come in with double the down payment per se. Because I always look at it with the local market. The California money obviously is a variable, right? You get it. Everybody's got 20, 30, 40% down, when I have my out-of-state buyers, but a lot of my local buyers are not 20, 30, 40% down. Mm-hmm. So it helps to have a little more product arsenal for them.
Yeah, definitely.
But for the government loans, it'll be even a larger win, I think, especially for the realtors, because now you can have, let's say if I have a buyer, I think we're buying for 360 and change, and that's, I think 369, and we're pushing it right on an FHA loan max. Now, let's say they go into the 400s, that same borrower, she would have qualified, but now she could buy a home 420, 430, 440. You get a little more for your money in that range right now. So I like it where it's going to give people more choices, because I could qualify a lot of people all day long for the FHAs, but I can't, the loan amount's too much. Mm.
Are you seeing more FHA than regular conforming loans
I've had a run. No, definitely not. The market share of conventionals are always going to be the lion's share. I do a ton of VA, but the FHAs are kind of, I'm seeing more of them right now. And FHA is great if you have a low credit score, because you don't get penalized for it like you do in the conventional Fannie Freddie world. If you have like a 630 Fannie Freddie, you're not only hurting on the rate, but you're hurting on the mortgage insurance if I can even get it for you.
Sure.
Whereas FHA, you can go down, really low. But if you have a 620, you're still getting out of there with a beautiful rate and pricing.
Right. So let's go over that, because I think we're good news is we're somewhat further removed from the financial crisis. So people's credit and history and documentation is much better these days. But, there's still quite a few that are out there What are the main differences in qualification from a guideline standpoint that you can think of that would be pertinent to people who are looking for homes right now from FHA qualification, disadvantages, advantages versus conventional, disadvantages and advantages?
The credit score, number one, because there's a FICO grid on conventional loans. So no matter what your score is, your scores are vertical, your loan to values are horizontal, and you land there. It's either a credit or a charge. Mostly it's charge. FHA doesn't really have that. Down to a 640, I pretty much have the same pricing. You have an 800 score, you have a 641 score, you're getting that same product. So when I got in the business, FHA was more like a first-time home buyer's tool.
Sure.
It just, everything comes in one. The mortgage insurance is great. It's 0.85. So let's say prior to a week ago, if you had a 640 score, I could put you at a 2.25 30-year fix with an MI on there. So you're at 3.05 all in. Now you're a little over 2.5. Like when you start, but that's still a great rate.
That's still a great rate, right?
No conventional rate at 2.5, and then that mortgage insurance is going to drop off in 11 years. So that person will have a 30-year fixed rate if they stay in that home for the life of the loan. That's incredible.
Yeah, that is incredible.
I've always liked the product. If I had to say any disadvantage, they charge a 1.75 upfront mortgage insurance fee, but that kind of goes to the pool and helps all their defaults and insure loans at 96.5% loan to value.
Right. So you can put a lower down payment too, 3.5%.
3.5% down payment, all good. Right. And it's a loan where, for example, I have a client that instead of giving her the 2.5 rate, we gave her a 2. I like to do a custom rate, so I did the 2.99 rate, and I'm able to give her $4,600 back towards closing costs.
Right. Right.
So it's still a good loan that way. And if 6 months down the road, 7 months down the road, she fixes her credit and gets into a better range, and we have that appreciation, then maybe her second home is a conventional no mortgage insurance loan in the future.
Right.
And stepping stone.
And the mortgage, the FHA hit the 1.875. Is that
1.75? It's financed into the loan. It's kind of like
it's exactly. It's financed into the loan. It's not like it increases. It doesn't increase the amount of money that the borrower has to come to.
Maybe an extra like $8-9 on her payment, something like that. If you look at it in the long term, but sure. if you do, here's what's nice about FHA. If let's say she does an FHA streamline loan, which is a product they build in for on-time payment. So if rates get lower and the FHA borrower is paying on time, they can do a no appraisal, no income loan real quick. It's called a streamline, and you do it in the first 3 years, you get a prorated refund of that, 175 toward the new one, so they don't just say, okay, it's
another one.
Yeah. So that's not, whereas let's say on the VA side, if you pay a funding fee today, and then a year from now, do another VA loan and you have a funding fee, you get no refund of that first one. You refunding fee it up. So it's a little more beneficial.
And with the FHA streamline, do they recalculate the 11-year MI period?
Yeah, it'll start over. It's a new loan.
Okay, got it. And so what are you seeing right now? I mean, as far as like, what are borrowers or even investors, right? We got a lot of investors coming in here to Las Vegas buying up homes here. I mean, I know a lot of it's the big guys, but there's probably still quite a bit of people who are waking up to the fact now that rents are continuing to go up, right? Drastically, and not like $50 a month, more like $300, $400, $500 a month difference here year over year from last year and the year before. What strategies and what loans are you seeing the most out there from your client base?
So personally, there's two types of loans. If you do a normal investment, like for a jumbo investment, I can add, I'll tell you right now what it is. I implore people to pay the buy down. I can get you the same rate as an owner occupied on a jumbo, let's say, if what's my hit? Anywhere from a 0.5 point to 1.5 points in price, how much they want to go down. So if I'm able to get somebody in, they want to buy a house and do a luxury rental. I've seen a lot of those lately where, $1.5 million, you're putting down 10%. Well, if you're going to cash flow that, imagine imagine the difference if I save you a half a point on that rate just by you paying a little upfront fee. It pays it over and over and over. So I don't like adding the investment hit to my full doc borrowers. When I have a non-full doc borrower, so self-employed, taking a lot of deductions, we have this new program. It's really how commercial loans are done. It's called the debt service coverage ratio, so DSCR. And it's really like a stated income loan from the past because the borrower doesn't matter aside from the credit score. All they care about from the borrower is down payment amount and credit score. The property with either the lease that's in effect or the projected rents, that's how they're qualifying this loan. So whether it's above a one, it's even up at 1 and 1, sometimes they can go 1.25, sometimes they can go down to 0.75. So if I have a $7,000 payment projected on the property and I have a projected rent of $10,000, it qualifies. It's that simple.
And they don't look at the income from the actual borrower itself.
Nope, they're just looking at the cash flow. So wow. I haven't done one with a first-time investor yet. That's actually something I should check upon. They want to see you have a little history. You're not just, you've never owned a property before and now you're, a rental specialist. So sometimes they'll have little caveats like that, but we had our two shows. Like we had an independent mortgage broker show and then we had the national show in town, Bellagio and Caesars, 2 out of the last 4 weeks. And that was the one that everyone's coming out with. I'd say the second one that I see for self-employed borrowers, it's more like an alternative income. They're letting a CPA prepare P&L, and they're taking that for the income.
Wow.
Just like that. If it's looking, let's say if they're trying to buy something that's just, a little abnormal, 2-3 million, they might ask for 3 months of your business bank statements just to justify the cash flow. But it's heading to, I think, a little more ease on the qualifications because everybody knows what's happening with inflation. The only thing that's not rising for sure is people's incomes. Everything else is going up. It's not like everybody's giving me raise. Oh, I got a raise. Like I'm waiting and hoping for those, but that's a way to keep the wheels turning. Make it not as hard for people that have some cash. These aren't 100% loans. The DSCR goes 15% down is the cheapest. But I also see, and then on another turn, as rates are going up and people have beautiful 2.5 30-year fix or 2.375 30-year fix, you're going to see the HELOC market really heat up. So I have a good one that if you have a 760 score, that's the key for this lender is a 760. They'll lend you prime plus 0.74. So it's a 3.99 loan right now. But that's a nice margin. 0.74 over prime money. You're not going to get the Fed fund money, but you're seeing a lot. You can go to 89.99%. And it's a 10-year borrow, 10-year repay. So, let's say I got you a $200,000 line. Mm-hmm. You bought a pool today for 80 grand. You hit one of Ruth's sports parlay picks and you paid it off in a year. And then 2 years from now, you want to put your, backyard of your dreams. You could still write a check from that HELOC just because you paid it back. It's not done.
So it's 10 years from the time you open the HELOC. Right. And that's on primary only?
That's on primary only. But good question. You'll probably start seeing those on secondary and investment residence, but never at that rate. But I think at that rate, when you're going behind a big loan, it makes so much sense because if I have to redo that loan right now and get them cash, it's 2.75 with a cost, 3%, no cost. And that if you think about the whole loan and you do the amortization schedule, it's not a really good move. It's a much better move to put the money behind and then you work to attack to pay that off, sure. The higher rate. You could separate it.
Sure. So I don't know if I asked you this last time when you were, Wells Fargo decided to eliminate all lines of, like personal lines of credit, home equity lines of credit.
It's interesting.
Yeah. And do you have any thoughts on why they did that? Why they exited that market?
Wells is weird. So they do their own decisions, but I think that they just would rather not, stay in the game with property at an all-time high. Whereas, because your risk level as a lender is going to be at an all-time high. If stuff doesn't keep going up, your LTV is really what that LTV is. Whether, but if you're lending at 70, 75, you have a cushion. Let's say properties go down 10%. It's not a big deal. But the guys that are lending at 89.999, they have a risk premium involved in that. And I think this Wells just didn't want to do it. And they cut signature loans too, I believe. Just like if you've paid your bills for 30 years, never missed a beat, why not lend you money? But they cut those out too.
Yeah, it's a little interesting, given why they did that. But
I'm seeing a lot of new lenders, just like, let's say, with the housing market activity, I'm seeing more lenders enter the market still, which is nice. The shows are getting larger and larger. They used to be huge back in the day.
Yes.
They're getting larger. You're seeing a lot of optimism in the industry. You're seeing a lot of shift toward AI and kind of predictive lending, I think, where, one of my wholesale lenders came out with a program where I could get my own approval in 10 minutes. If I could get my own appraisal in 10 minutes, it would really help me. But, you're seeing stuff to make sellers, realtors, everybody happy, all the complaints. Why can't you do this faster? Why can't this be more easy? It's coming out. Another lender's coming out with a basically AI assistant that I could text to and say, please update Ruth that I received my last closing docs or last closing condition, and docs will be out shortly. And it'll do all the calls and messages for me. It's interesting the way it's going.
Yeah, this lending and real estate process, for whatever reason, has been so archaic in nature for so long, right? With technology and the streamline effect. I know they're trying to prevent fraud and stuff like that from happening. Well, fraud is all continues to happen regardless if you have AI or human intervention in it. But I think you can remove a lot of the mistakes that happen with human intervention with some technology and AI situations and streamline the process. You're right. It's still very cumbersome.
And it saves everybody money in the end, because the quicker something gets done, the less we need to lock a loan for, which number one is better. And then on the back end, the lender can set their margins, or the investor can set their margins skinnier if the time to sell that loan is cut down. Mm-hmm. So it does help everybody. The appraisal issue is being attacked by all these lenders. A lot of them, have heard our cries of why is it taking 2-3 weeks for an appraisal? And I'm seeing major improvements in that.
Why is that? Is it just too much business happening right now and the shortage of appraisers?
I looked it up in Vegas. There's more appraisal management companies than there are appraisers.
Right.
So it's just the way our rules are to get. I believe you have to be an intern for 2 years out here to become an appraiser. Mm-hmm. And then so half the battle is allowing somebody to want an intern, right? What if everybody says we don't want interns? So
that's stupid.
And I saw something in South Dakota where there was one of the politician's daughter got assigned to be an appraiser, but it sounded like they have a similar process where it's kind of hard to become a licensed appraiser. That would solve everything. If they doubled appraisers from a little under 500 to 1,000, wow, that would be amazing. But baby steps on that, I guess.
Right.
Well, this market's not going to slow down, so we're going to have more appraisers at some point.
I would bet that this 2021 would have to be the all-time record year of any appraiser's income. I mean, what they've been allowed to charge this year is nuts. It's really that's what kind of bugs me the most is if I could get a consistency of a time frame and then a consistency of a fee schedule, you live with it. But every day, week is kind of different, and you're at their mercy, because without that, there's no deal.
So yesterday, one of our agents gave me a call and said, Ruth, I just had an appraiser tell me, now he represents the seller, not the buyer. I just had the buyer's appraiser tell me that it's going to cost $1,200 because it's a hard property to comp.
Yep. So one of my first loans was in Tiburon, California. And
It's a nice place.
It's very beautiful, very beautiful. And so, but I remember because the appraisal cost $1,800, and I was like, oh my God, this is, I never had any clue, but the guy measured and it was custom. It was like a 6,000 square foot home on the water. And the guy said he was there for 3 hours. Whereas you have this same appraiser that charged you $1,200, he's going to be at that home for 10, 15 minutes.
10, 15 minutes, right.
And then he's going to go on to the next one.
Yeah.
So I'm not sure, but what can we say? No, it's not hard. You can't tell somebody how to do their job. But I get those exact same ones too. Yeah. The only one I've had semi-recent that I agreed is if you have like well or septic and it's a large sales price, there's only so many out here.
Yeah.
Like how many $1 million septic homes are there? So you got to go out far and wide to get the comps. But aside from that, paying that much it's a new phenomenon, never before this year.
Well, with technology though, you can go outside and get the comps, and plus the appraisers are even asking the realtors to get the comps. So
how does that work now in the lending world? I know before, a decade ago, right before the financial crisis happened, the mortgage lender can literally choose the appraiser that they use. Now it's just going all through these management companies.
Yeah.
And then
the Dodd-Frank, when they changed our compensation and everything too, they threw in this appraisal management company, and they're fine, as long as they have penetration in the county. But what I find is hard is if you have a company that's on the East Coast or in Michigan or Florida, and they're trying to work their 9 to 5 to do 9 to 5 work out here, it's not happening. Most appraisers I know are either, early morning doing stuff on the emails or at night catching up after they've been out all day, taking pictures and writing their reports. But if they're at home at 7 and you have an East Coast appraisal manager company, there's going to be no communication. So, it's just, you're, I don't know, you have like one strike already to try to get something done quick and easy. I just think that local appraisal management companies should be more prevalent instead of trying to do it in every city, state, across the nation.
Right. Because
so I do loans, they do appraisals.
So a lender sends a request to these appraisal management companies, and then they choose who.
Yeah.
Are the appraisers independent contractors to these guys, or are they actually employees to these management companies?
And that's the issue. They're independent contractors. So, is there loyalty? Because if they're not just a member of one appraisal management company, they might be a member of 10. So if 9 out of the 10 are offering you 500 and the 10th guy is offering you 1,000, of course you're going to pick the 1,000. So it's just everybody's bidding for the same. It's almost like you're betting on a horse, and the odds, as everybody bets on them, the odds goes down. In this case, as everybody bets on them, whoever has the highest is going to win. And then you have to worry about turn times. So when we're requesting a report, we can say, I need this in 7 days, or I need this quick, and do a rush fee. But what I'm having to do is I'm having to put $1,000, $1,200 appraisal estimate, because I don't know what it's going to come in at. And I want to make sure that I'm not undercutting myself by only offering the standard 450 or 550, whatever, the smart fees picks.
Sure.
So that's been the battle, and some of the lenders are doing their own AMCs now, and they're trying to eliminate, that AMC fee, because what do they make? They don't do it for free. So They make anywhere, 125, maybe up to 200, a deal. So if they can plug that back into paying the appraiser, it's going to help get our reports picked up and done. But I feel paying for that appraisal just to get it done and over with is, if I can supply my rates and everything, but my appraisal fees maybe, a couple $100 more, but I know that it's going to save them, weeks of stress and just get that out of the way, because until that we know if the sales price is hit, there's a lot of uncertainty.
Sure.
No one wants to hang on for 2 weeks and then we go back to the drawing board because it's $60K short. I just want to get it out of the way. Let's figure, and then we can go and finish the loan.
Yeah. So Are there not many AMCs here out in Vegas locally?
Well, even if they are, I have to have permission to use them. So it's a matter of the lender being signed up to use that AMC. It's just, there's a lot of strings
stuff,
that
right?
To work. Yeah, I can't just find my own AMC because they're worried. What if I take them out to dinners and trips?
Yeah.
And then they're going to say, what value do you need? That's what they kind of got out of our wheelhouse when they went to AMCs, because back in the day, yeah, you could have relationships with an appraiser, and they don't want anybody to influence the value.
Right.
And that's it's acceptable, but let's get on a better course where I know, like, I wish there was 3 different tiers I could pay for, like a 500, a 750, and 1,000, and knowing how quick I could get something back. That's all I care about is the speed. I'll never, we could do rebuttals on value, but I'm not, I do my own little due diligence before I send the thing over. And, I know if it's going to be close or if we're way out of the park on it. I can, I look at the same data. It's not like the data's, mystery. You go on like a Type site, or, we have House Canary that also gives like a low, a high, a median, and it shows where it brought it from. You can see the distance, so I like to look at that, because a lot of times people, when I'm doing my refinances, will see homes that are close, to them, but they don't realize their home was built in 94 and that home was built in 2015.
Right.
So I could see that and kind of stop and say, hey, we may have an issue because of this, this, and this. And as long as we kind of talk it out in the beginning, then when it goes to the appraiser, I know, like, hey, we're going to get what we get, but at least no one's going to be shocked. So I think everybody should kind of do that. The realtors do it. I mean, before they make offers and, set listing prices, they kind of know where it's going to fall. And if you're pushing it too, and maybe it works because something could sell in that interim. There's always awesome listings. That's another thing. People get excited about listings, but until that thing sells, it really doesn't do much for you.
Right.
Exactly right.
Exactly. But it gives us hope. Like, okay, as soon as that home sells, call me, because now we have an amazing comp in your neighborhood and we can work off of it. But it's nice. The data used to not be that readily available or as quick as it is now.
Yeah. Yeah. Home stays on the market 22 days. So average.
Now, are you seeing? So in the beginning of the show, you said that incomes aren't rising. Are you seeing borrowers coming in where they're having a hard time qualifying right now because of the loan or the prices coming in too high?
No, I didn't mean it that way. But let's say 2020 for a lot of people was not a good income year. Had time off work, a lot of stuff in forbearances, and that's the return that we're looking at right now, really heavily. So I have a lot of hourly tip workers that I have to explain, why doesn't it match up? Why does my 2020 earnings not match up with what we're making in 21 or what 19 showed? And sometimes you have to get letters, and it's hard to get letters from employers that use the work number or electronic verification service, that they just don't want to do it sometimes. So that's been a little bit of a small headache. Once we get into next year, because I think 21 will be an amazing income for a lot of people. So the following year, I think we're going to have like a nice spike in kind of qualifications that it'll get a little easier. But then the battle is there 22 going to be the same? Because if you're declining ever, it's always an issue for us. Sure. You can have this amazing 21, but now all of a sudden, you're back to normal in 22. I'm going to have to use the back to normal money.
Got it. Well, Marc.
Complicated.
Yeah. A lot of stuff, as you can see, going through the lending process. So if you have a question or a need, or an agent out there needs, really professional mortgage lender that knows what they're doing and they're talking about and the whole process, reach out to Marc. Marc, appreciate you coming back on here.
You're
Thanks
welcome.
for all the information. Ruth, stroll how to contact Marc across the screen, if that's possible.
Marc, let me have your phone number.
702-929.
929.
8220.
8220. Okay, let's put that on the screen for everybody.
Text is also amazing. I'm a great texter.
There we go.
Yeah. So there you have it. Marc Conn from Community Access Lending. Appreciate you coming on, Marc.
Keep up the good work. Talk to you soon, Ruth.
Yes, very soon. And Marc's currently doing a loan for the All Brand team.
All right.
Yeah. And we always get such awesome reviews about you, Marc. I have to tell you.
It's all approved. Appraisals in the works. Yeah. Well, let's take it down.
Okie doke.
Okay, take care, guys. Have a great weekend.
Thank you, everybody.
Take care. Hey, Ruth, what's happening in training this week?
This week we are having, let's see, let me get him down for a second. Hide him. Okay. So we have, show this in this screen here. On Monday, we have 2 to 5. We have the Attorney General's on line 1. And this is a new class that Jimmy Dagg wrote. I helped him with it, but he needs to get the credit, not me. And it's from 2 to 5 on Monday at the training center, or you can Zoom. We already have lots of people signed up. Our law classes get probably the best capacity because there's not that many people that teach law. And a lot of the people a lot of the law classes, a teacher or an instructor may borrow it from someone else, and it's not really, it's not refreshed information, and it's kind of boring. So I always say law is never boring with Jimmy Dagg. And then on Thursday, we have a class in, ethics. And that's, ethics is an interesting subject, Max, because most things we can quantify, but ethics is more personal. Everybody has their own idea of what ethics are.
Sure.
And so that class is it's controversial. Let me put it like that. Everybody say, it's like, well, what did I just learn? Well, I can't teach you ethics. The Board of Realtors, we have 17 articles of how to act ethically with, our fellow realtors and also how you treat the public. But at the end of the day, it's a very personal thing. But it's a great class. It's 10 to 1 at 8400 West Sahara. Please sign up at bee.vegas, same place you're going to sign up for the law class. And this is just a calendar. We also have what do we have? Another law class on the 3rd. Yes, we're going to have another one on the 3rd. Now, the amount of credits that an agent needs has increased. So we're going to be having 2 classes a week starting in January. You can see here we've already kind of started to do it. But because there's so many more requirements now, we're going to be doing more classes, which is good. And we're going to be writing some new classes like risk reduction. And Jimmy and I have kind of penciled out a property management class. And so we're going to have lots of things going on next year. Kane and I sat down, took us about 4 hours the other day to map out the entire schedule for 2022. So we have it all mapped out, ready to publish as soon as Jimmy gives his okay.
Fantastic.
So yeah, I know it's exciting. And there's a lot of new things going on all the time with training. And it's been a whole new world for me. With real estate training. I'm used to technical training and social media training, but this has just been such a great ride. I love it.
Yeah, absolutely. Yeah. So, you entered it at the most perfect time, Ruth.
Yes, I did.
All right.
Timing's everything.
Timing is everything. So, well, fantastic. We'll sign up at bee.vegas, everybody. Thank you for tuning in today's show. We will see you next weekend, and tune in to